You've done it. You found the perfect home, you're pre-approved for a mortgage, and you're ready to start packing boxes. It's such an exciting time, but it can also be a little nerve-wracking. The last thing you want is for something to go wrong with your financing at the last minute. The good news is that most mortgage approvals go through without a hitch. But there are a few common mistakes that can sabotage your loan and cost you the deal. I've seen it happen more times than I can count, and it's always heartbreaking. I'm Kris McCullough, a loan officer specializing in property financing, and today I'm breaking down 3 common things that can kill your mortgage approval and how to avoid them. Let's dive in. Alright, so you've been pre-approved for your mortgage. That means a lender has looked at your finances, your credit score, your income, your debts, and they've said, okay, you look good for this amount. But here's the thing, that pre-approval isn't a guarantee, it's conditional. Think of it like this. Your lender has given you a thumbs up to borrow money, but they're keeping a close eye on you until the closing papers are signed. They want to make sure nothing major changes in your financial picture. And that's where new credit comes in. When you apply for a new credit card, a car loan, or even finance furniture for your new place, it's a big red flag for your mortgage lender. Here's why. Every time you apply for credit, it gets logged on your credit report as a hard inquiry. Too many hard inquiries in a short period can actually lower your credit score. And it's not just about the credit score itself. Lenders also look at your debt-to-income ratio, or DTI. That's the amount of debt you have compared to your income. When you open new credit, you're potentially increasing your debt load, which can throw off your DTI and make you look riskier to lenders. The solution? Simple. Put a pause on any new credit applications until after your mortgage closes. That means no new credit cards, no car loans, no financing deals, no matter how tempting they seem. Once you've got the keys to your new home in hand, you can revisit those applications. Let's talk about money mysteries. Lenders love clarity. They want to know where your money is coming from and where it's going. It's all about making sure everything is above board and that there's no funny business going on. And that's why large, unexplained deposits or transfers in your bank account can raise eyebrows. Imagine this. You're in the middle of the mortgage process and suddenly a large sum of money appears in your account. Maybe it's a gift from a family member, or maybe you sold some investments. Whatever the reason, if you can't clearly document where that money came from, it can bring your loan approval to a screeching halt. Lenders are hyper-vigilant about these things because they have to follow strict anti-money laundering and fraud prevention regulations. They need to be able to trace the source of your funds, especially for large transactions. So, how do you avoid this potential pitfall? Transparency is key. If you're expecting a large deposit, talk to your lender beforehand. Provide them with the necessary documentation, whether it's a gift letter, a sale agreement, or a bank statement showing the source of the funds. And here's a golden rule. Don't try to hide anything. Lenders are really good at what they do, and they will find out. It's always better to be upfront and honest. Remember, clear and consistent financial behavior is your best friend during the mortgage process. You're in the home stretch of getting your mortgage approved. You can practically smell the fresh paint in your new place. But then, a curveball, you get a fantastic job offer, more money, a better title, the whole 9 yards. It's tempting, right? But hold on a second. Changing jobs, especially during the mortgage process, can be a risky move. Here's why. Lenders want to see stability. They want to know that you have a reliable source of income to repay your loan. When you switch jobs, it creates a question mark. Even if the new job pays more, lenders might be hesitant. They'll want to verify your new employment, your salary, and your job history all over again. This can lead to delays and, in some cases, even loan denials. It's not just about new jobs either. Any significant change in your employment situation can raise red flags. Going from a salaried position to hourly, becoming self-employed, or even switching from one commission-based role to another, these can all impact your loan approval. So what's the takeaway? If at all possible, try to maintain the status quo with your employment until after your mortgage closes. If you absolutely have to make a job change, talk to your lender immediately. They can guide you on the best course of action and help minimize any potential disruptions to your loan. Look, mortgage approvals aren't just about numbers, they're about timing, consistency, and knowing what not to do. By avoiding these common mistakes, you're setting yourself up for a smooth and successful home buying experience. I'm Kris McCullough, loan officer and real estate finance expert. I'm here to guide you through every step of the mortgage process and answer any questions you might have. You can find me on Facebook, Instagram, and YouTube, or visit krismccullough.com to check out all the loan programs, download free ebooks, and use my 14 loan calculators to run the numbers for yourself. Let's make sure your mortgage goes through smooth, simple, and stress-free.